Good afternoon, everyone. Welcome to the webinar today, which is the 5 elements of suitability, brought to you by the Financial Suitability Forum. Today, we're going to be working through each of those 5 elements. This is an introductory webinar that's going to give you an idea of what each of those headings is about. There's going to be further webinars down the track that will let you have a look at each one of those. So let's bring everyone up now. Hi, I'm Craig Saunders. I'm your host for today, and I'm here with Paul Resnick, who's the convener of the forum. Paul, can you hear me?
I can indeed, Craig. Good morning.
And good morning to our viewers in both the US, or sorry, good afternoon to our viewers in the US and the UK. Paul and I are both in Australia, so it's quite early in the morning here for us today. So let me take you to the first slide that we need to talk about today, which is these are the 5 stages. Some of these pieces are going to be familiar to you, but we might be looking at them through a different lens and through different eyes to what you've seen them before. So the 5 elements of suitability that we need to talk about today are, first, to know the client, perhaps in a level of detail that you're unfamiliar with or you're not unaccustomed to know the product, again, in a greater level of detail than many people currently do in their work, to justify the connection between the two, to have a reasoned rationale that another person could look at and sign off on that, yeah, I see why this person and this product were the right fit at this point in time. We're going to introduce something called informed consent, which is not often discussed in financial services, but it means that we're having the client agree to the process that you're putting them into rather than bamboozling them into signing something that they'll later say, well, I didn't know what I was signing myself up for. And then the final stage is to maintain suitability, which is to review the client and review the investments as time and circumstances change. Now, Paul, as I said, many of those elements will be familiar to different people in different ways, but often they're not put together in the level of detail that would lead to what we're calling suitability.
And the challenge is that we've come from a background of selling equity risk, and that's been the history of training and education in financial planning over the last 20-25 years. The notion of investments being for the use of clients, for their benefit in meeting their life goals, has increasingly been in our industry media and now in the general media. And to put a construct around it has been our greatest challenge. So we've always known that we need to know the client and know the product. We just haven't had a very useful emphasis on each of those. And perhaps the most telling that has been the need for clients' informed consent and effectively ongoing informed consent, because that's where all the value of businesses and planning comes into play. It's all very well to say, well, this matches the client's needs. I've talked to them for 5 minutes and these are my favorite funds and I've researched them for the last 4 or 5 years, but we really haven't known the client. We really haven't had a very strong basis in many cases for the ongoing service fee that underwrites both the services we give the client and underwrites the value of our businesses and gives us the cash flow to support our staff and to maximize our succession value of our business when we want to merge it or sell when we retire.
Can't we point the finger largely for that at the regulations that many people have operated on? Because it's a sad but sorry fact that a lot of the financial services sector is only interested in meeting the absolute minimum of regulation that they must in order to make a sale of a product. And so if the regulation is only required that you know 3 things about your client, that's all they've known.
Well, the dilemma, of course, in our industry as I travel the world, it goes something like this. I arrive somewhere and it could be New Zealand, it might be India, it might even be Bulgaria. The first conversation goes something like this. Somebody will whisper in my ear in a sort of embarrassed way, look, I need to tell you 2 things. One, people here are different. They're fundamentally different from anywhere else. And two, our regulator, they understand nothing. Now, the first is fairly obviously untrue. People are people wherever they are. Their cultural background may be different, their skin color may look different, but fundamentally we're 99.9% the same. And our behavior in relation to money is really no different. In terms of the regulation, it is true that the regulators often are trailing best practice, but they've all meet fairly regularly and do put a sterling effort into at least repeating the mantra, but taking into account individuals' needs and circumstances. But it's often only that, repeating the mantra, that their understanding in turn of the benefits of a great match, of the product actually meeting the needs of the client, both initially and ongoing, is often relatively superficial. So the answer is yes. Lots of firms choose to follow the regulator because they too haven't quite grasped the benefit of quality suitability.
And I think we have to acknowledge the big change in regulation that you and I have seen is that if we go back 10 years ago, in virtually every jurisdiction, regulation was based on what we might call disclosure. If I'm disclosing my fees, if I'm disclosing my conflicts of interest, if I'm disclosing risk, and we'll come back to that later, if I'm doing those disclosures, therefore the client must understand. And drawing that was a big chasm to leap, because putting down 100 pages of disclosure in front of somebody who's unskilled in financial affairs did not at all mean that they understood anything that was being put before them. And many people blindly signed off on the documentation and were horrified when 2008 came along and they saw the volatility in their investments because they had no idea what was coming. So as a result of that, regulators are going, well, disclosure's not working. And so now we are seeing a shift towards regulation that is being built around suitability. Our viewers in the UK today know it very well through MiFID II and what the FCA is imposing on them there. But there's also discussions around this in Canada. There's some draft legislation in Australia that after the change of government this year could see product rules very similar to those in the UK. What these rules are saying is, hey, if you're selling products, the onus is on you, because we know that the people you're selling them to, or the people you're giving advice to, can't necessarily appraise whether it's good or bad. So we're going to hang it on you whether it's good or bad. And that's the big shift, where it's gone from let the buyer beware to let the seller beware.
And I think that the point to emphasize here is the word informed needs to be seen in lights. Consent is ostensibly, yes, I clicked on because I wanted to move on, as we do with whenever we're on the internet and we arrive somewhere, but it's not informed. Informed means that we understand some of the consequences. We understand that there are not only are there conflicts of interest, but there are fees, and those fees have in turn consequences and outcomes. That the rate of stock turnover is disclosed, that the future volatility of the particular asset class is based on the past. There's a whole series of things that you need to be able to illustrate to be able to say informed.
And let's just acknowledge, you've raised fees there. It's not one of the elements, but it runs through all the different elements, that fees and costs are a fundamental component of suitability, because if we model a long-term investment horizon, 10, 15 years, a difference in fees of 20, 30% can make a profound difference to the outcome for the investor at the end.
It's certainly true. We've, as many of our users, subscribers, will have had the opportunity of looking at our back history. We do almost a 50-year back history of risk and return in 9 countries. And I was just looking at our global returns last week, a 60-40, a 60% equity portfolio and a 40% bonds, taking into account home country bias and inflation over the last 50 years, has returned in 6 of those countries, give or take 6%. So if you have a 20 or 30% increase in fees, that can bring that down to 5 and 4 and 3 over inflation. That's a big bite in terms of retirement purchasing power.
It's caviar versus cat food.
Well, it's caveat emptor if we continue that. It means that yes, people have seen the fees, but they haven't necessarily understood the consequences, and that's been a primary driver in the passive versus active debate we've seen over the last while. It is always the simplest argument that will prevail, and if you can show people that the access to the markets is effectively going to be free compared to the 1 or 2% active management costs might be, that can be as much as a third of the return that's going to be available. So it's going to be a hard road, I think, for active managers to be able to disclose their fees and their value and get clients informed consent, because that's effectively what they've got to be able to do.
So let's go to the 5 elements now. And the first is know the client. And that data that you're referring to, for those of you who don't know Paul, his business in financial services for more than 20 years was the Phenometrica, and is the Phenometrica risk profiler. And he's collected data on more than 1 million people around the world on their financial risk tolerance. And that comes into play in their risk profile, which is the first stage of know the client. And Paul, based on that 20 years experience that you've had, people model risk profiles in all sorts of different ways.
Well, they sure do, and they still do. I was just looking at some of the latest US data. More than 50% of US firms still use their own approaches to risk profiling. And that's not to suggest that they haven't robustly and scientifically developed a methodology, but I know how much work it's taken for us to build a psychometrically relevant risk score and to understand the interplay between the client's various goals, aspirations, and characteristics. So understanding the client is actually is both a regulatory obligation, but is a professional advantage. You know, it's fairly clear that those organisations that best understand their client have the best relationship with them, because they've built that relationship on an intimacy of understanding and effectively collaboration that just didn't exist. The technology and the psychological preference for collaboration and sharing are really very, very contemporary compared to the much more traditional, that this is the right product for you, this is my professional view, as opposed to the much more, much softer. We've talked together about your competing goals, and this is our suggestion of the 2 or 3 major ones that we need to work through the trade-offs. And the most classic is that people have a relatively low risk tolerance, but have a relatively high need for equity exposure. That needs to be worked through. The client will either be get a lower long-term return, or have to live with a higher exposure to risk than they're naturally comfortable with. There's nothing more relevant than the client signing off on that, not an advisor and not an algorithm.
And that's an interesting point that you raised there, that the person may need to live with more risk than they're comfortable with. That's allowed to happen when you measure someone's risk tolerance. If you find that their circumstance calls for them to be going much harder than their risk tolerance would suggest, and they will sign up for that, that's not necessarily out of the ballpark.
It's not out of the ballpark. It has to be treated with great care. Particularly if you're doing a long-term plan. I'm always amazed when I look at younger people with lower risk tolerance and read, well, the natural thing we need to do is give these guys a high exposure to. In the long term, that's true, but in terms of material outcomes, it's a very dangerous position to start. Often they've got very little money, and what we put at risk is terrifying them, that within a short period of time, the market's correct, they feel bruised, and they move away from the long-term greater certainty of equity returns because they've been so battered by the experience. We need to take into account their personal circumstances. We need to take the chance to build confidence, and there's nothing materially lost by starting off with an equity exposure that's more consistent with their risk tolerance and working with them over time to increase that exposure and to increase the benefits. There's no likelihood that we can predict their risk tolerance will change with knowledge and experience, but their confidence and perception of risk will. And that's well worth having. That's the quality of a relationship that comes with transparency and informed consent.
So in that risk profile, we have the capacity to bear losses. We look at their current financial situation, but we also have to measure their risk tolerance, as you said. And the way that you've done it for over 20 years is psychometrics, and you clearly think that's the superior way to do it, this psychological measuring system.
We spent 4 years researching the marketplace before we got to psychometrics, and along the way we came across gamble theory. Many of our listeners today may have come across gamble theory. It's often referred to as coming from some of the work of Daniel Kahneman and his view of prospect theory. Essentially, it's a recognition that we value gains and losses differently, and the investor is, when subject to a gambles based test, is asked for their acceptance of an upside in 6 months or a year versus a downside in 6 months or a year. So you will perhaps, listeners, remember there may be a $2 or £2 to £1 gain to loss to get to the same, or £3 or £4. Sounds very easy and very natural. There are just a couple of unfortunate outcomes in Gamble's test. One, there doesn't seem to be any evidence that a Gamble's-based understanding has anything to do with risk tolerance, so it's not valid as a link across. And the second test is, will the next time you do it get the same result? That is, will it be reliable? And there doesn't seem to be any evidence that it's reliable either. So Gamble's-based tests are neither valid nor reliable, and in fact entirely inconsistent with the notion of investing anyway. So I'm still somewhat agog that anybody would put their business at risk using a Gamble's-based questionnaire. We looked at it and said there was just no way it was a worthwhile approach to take to assessing risk tolerance.
So now that we know all those things about the client, we need to know an equal number of things about the product. We've already talked about the costs, that the amount of fees that you're going to pay for a product or an investment plan is highly significant and important. Many people will have explained risks and returns, but only at a superficial level. And you alluded earlier to your 50-year risk return guides that you have within Finometrica. Run us through what a proper illustration of risk and returns being explained to a person would look like.
Well, the most obvious is that there is volatility, and that volatility comes on a fairly regular basis. So we, for instance, look at the 10 biggest falls a portfolio consistent with risk, with different asset allocations. So let me go back to an example. In the Finometrica process, we know that clients typically have a risk tolerance score of 50, and that generally ties across to a growth asset, a risky asset exposure of give or take 50 or 60%. Typically over the last 50 years, there will be a number of falls of 10, 20, 30% with a portfolio like that. Sometimes the fall is precipitous. It drops in 3 or 4 months and recovers as quickly. Sometimes it's a very gradual fall and a gradual incline, and other times it falls gradually and recovers quickly. So unless a client has some sense of what to expect, how they, in a sense, we argue that we need their expectations to be appropriately framed. They're going to be caught up in the bad news that will go with those corrections and slow recovery. So that's a very good example of how we need to illustrate that when a correction kicks in, and they happen every 10 to 12 years, it can take a number of years to recover. You can't generalize from one country to the next, and you can't guess when it's going to recover. And if, as we all know, the dominant client base of advisors is baby boomers who are working their way through the early stages of retirement, that can be somewhat frightening, because there's a recognition for many of us, me included, that you don't get a second bite if you have to crystallize assets to meet your liabilities because you hadn't appropriately cash flow managed for it. You can be very frightened.
And to be explicit, what we're trying to avoid here is people getting the shock of their lives when markets correct by 10, 15% over a day or a week or a month, and selling out their investments and then missing the recovery that inevitably comes at some point, as you said, even though it might take an extraordinarily long time if we look at Japan, for example. So we want to avoid...
We look at Austria. We look at Austria. Austria was a dominant economy at the early part of the 20th century. So our Austrian investors have also had a miserable time.
Because if you sell out at the bottom and you miss the rise back, you're a 2 or 3 time loser. And if we go back to the goals, that's probably the most catastrophic thing that you can do for trying to achieve your goals, is to abandon the plan because you suddenly got outside your comfort zone.
And that's right. So knowing the product, so let's go back to that. For a long time, the industry was essentially a product promotion activity. And now when you go to goals-based planning or suitability, it's much more how the product matches the client's needs and how well the advisor can prove that. But that's perhaps the single most important issue that's emerged, is suitability is your basis for in evidence of how you've matched the product to the needs of the client. And amongst the regulatory obligations and the common sense obligations is the UK one, is every tool you use, you have to have done a due diligence on, looked at its strengths and weaknesses and mitigate the weaknesses in your offering. If that was applied to your stock selection, manager selection, portfolio construction, in turn, you need to have a pretty robust methodology to show that that's been done well. So in the UK, what we've seen is a very rapid growth in products that are at the portfolio level, not just at the asset class level, because that's an infinitely easier approach to proof of integrity of process. And suitability, now your product, I suggest will continue to simplify the communication of product, at the same time as we talked earlier about making our understanding of client ever more challenging, and with the benefits of technology and data ever easier to do.
Well, I can remember not too many months or years ago where somebody would have described a fund as, oh, look, this is an emerging markets fund, so it invests in emerging markets, and they're the ones that aren't the US or the UK. And yeah, you should have some of this. And today that just won't fly under the rules that apply in the UK and even and are pending here in Australia. You have to know the key. I've got the list up on the screen now. You need to know the key features of the product, and that's probably where things have stopped before. But what are their mandates for investment? What are their policies? What will they do? What won't they do? How are they short, long, or just long? What are their total costs, fees, and charges? As I said, that's a recurring theme that pops up in every one of these elements. What's it costing? What's it costing? What are the tax implications? How often do they trade? What's that going to mean for my investor? Are they passing through tax liabilities? What's the potential for the asset price volatility? How much could this go up or down? Could we wake up one day and see it down 50%? How much bottle do people have to stay around when that happens to them? And that's that risk return analysis that you were alluding to earlier. So this is a far more in-depth knowledge of products than I think many people would have, but particularly in the UK under the regulation, it is the depth of knowledge that you're required to have.
And it's when you're faced with these levels of responsibility as an advisor, and it's when you realize that most of the education that you've been given has either been relatively superficial in relation to these things, or has in fact come from fund managers, that you realize just how vulnerable you might be. I'm always surprised, I guess, when I come from the UK and go to other countries. Almost invariably, there's the sense that advisors and advisory firms are on top of all of these issues in each country. But it's only when you understand that when you've constructed for a client, for instance, a portfolio of maybe 6 or 7 different funds, that you need such a high level of transparency to what assets are in there and what approach the manager is taking, to understand that you may well have one manager that is exposed to a stock and is increasing it, while another manager is selling that stock to move to something else, incurring both fees and creating tax liability. To understand that you're going to be subject to much inferior returns unless you're able to see and control what's going on. So the portfolio approach gives many people a much greater confidence, many advisors and clients, greater confidence that they're going to get a more predictable and reasonable return for the risk they've taken on.
I've just got some extra detail about the UK prod rules up on screen at the moment. This is the product governance rules. And Australia's pending product governance rules are based on these ones in the UK. They're a mirror of them. And the big change here that we have to acknowledge is that product issuers have a liability on them in the UK now to define who their product is suitable for and who it's not suitable for. They have to define a target market and then monitor that their products are only being sold to that target market. And if they're being sold outside of that target, have a jolly good reason why that would be so.
And this is, of course, a huge change, isn't it? If we look at the whole of the financial services marketplace, the only player who had a fiduciary obligation was the advisor. Well, what does a fiduciary obligation mean? It means that they act on behalf of the client. That's a much higher standard than prevails for any other supplier of product and service. All of a sudden, it's not a sequential liability where it's the client, the advisor, and all the service providers, with the service providers in a sense protected by the advisor. We now have a parallel liability for fund managers, platforms, and and advisors for suitability. And this perhaps is a game changer because many investment advisory firms have taken all of the liability. Now it's the fund managers who are taking on some of that liability. And of course, they don't have the technology or the vision to know where their product has ended up. So we need a substantial reworking of the communication process. If I'm as a fund manager saying I expect this to be sold to clients with less than $500,000 with a need for a diversified portfolio, I need to know that's where it's been sold. It's not good enough for that information to be withheld or not be relevant because I was just selling through a platform or a custodian that aggregated all of the money and didn't communicate to me the data. So big changes afoot with that change of liability, compounded by the senior manager regime that is emerging in the UK and a similar version on the boards in Australia.
Yeah, that's bringing an accountability, a personal accountability that's not been there for many people before. And this kicks us along into this third stage, the justify the connection or explain the connection. We have insights into the client, we have insights into the product. This is the point where we put the two together. And it's important to acknowledge here, I might just stop the screen so we can come out for this for a moment. Important to acknowledge here what suitability is. Suitability doesn't mean it was the best possible choice that could have been made for the client. And a couple of reasons for that. The first is that really only in hindsight will we ever know what the absolute best choice could have been anyway. But suitability doesn't have to be the best. It just means it's right for the person in the right circumstance. So for example, if I say to you, it's cold out today, wear a coat, that's an issue of suitability. Whether it should have been that coat versus this coat, a red coat versus a blue coat, they're issues of debate. But the issue of whether you needed a coat because it was a cold day is not so much of debate. So what we're talking about here when we talk about justify the connection is have a reason and a rationale that puts the product or their plan together with the person. So based on my analysis of the person, based on my analysis of the product, there's a good fit between the two of them. And that's very different from trying to hit what you would call the best possible outcome.
And it's also, it emphasizes that it's about process and not outcome. I think there was a general view in the industry for a long time that if you went to a planning group that had offices in 3 or 4 different cities, and a client who went to each of those should expect the same recommendation. I think the understanding now is much more the process to get to the recommendation will be similar, but the individual emphasis may alter, may be different. And it's very clear as we understand more and more about the complexity of decision-making in financial advice that not only do clients bring biases to their decision-making, but so do advisors. And those individual biases are often not as well disclosed to themselves as let alone to their clients. And we can see that in some of the work that I've been looking at recently, where individual advisors weight the major characteristics of the risk profile quite differently. Some rate risk tolerance very highly, much higher than risk required to achieve goals, yet others emphasize risk capacity. That is what happens when everything turns south, and the client's ability to cope with that. So it's quite clear we're in a very, very substantial learning stage And the best way to manage it is to make sure we've got a well-articulated procedure, and that procedure is well recorded during the planning process.
And if we take it back to where we opened up with, you've got to know the person's goals. If we look at it, an analogy that I've seen many times in financial services is, we're going to draw you a roadmap. Here's where you are, here's where you want to go, or here's where you want to get to, and here's the route that you need to take to get there. Now, if we think of that just in our lives, if we say to somebody, look, we're going from this town to this town, which way should I go? One person will say, oh, take the M1 freeway, you'll have a great trip. The other person will say, oh, you wouldn't take the M1 freeway, that can get busy this time of day. Both are probably fairly legitimate answers based on what they know about you, what they know about your journey.
And that's right, and it is a journey, and we're all going, if we look at what can happen along the way, we can, the weather can change, the road can be dug up, our mood can change, our health can change. It is a journey, but it's far from certain.
So if we look at, I've got back up on screen now some of the requirements of this justification, and a lot of this comes from the UK, where the rules are probably the most detailed in the world that we have at the moment. And one line that I like from there is that they want clear, heavy lines. So this is where you draw the point from point A to point B and go, look, this is what connected the client with the product. They want illustration of how the risk profile aligns with the advice, the risk profile of the recommended products, all in concise, plain language that the person can understand. And that's a very high hurdle in some circumstances when you start dealing with complex products. It might require images and infographics because not everybody can analyze huge reams of data, disclosure of all those risks and uncertainties, and disclosure and comparisons of costs. This, for example, product A looked really good until I got to the costs, and I just couldn't justify it over product B when we compared the fees because product B was cheaper.
And of course, you can see just looking at this list, the great challenge and what's forcing advisors to move to pre-constructed portfolios, because it's a huge responsibility if you're actually going to be selecting half a dozen individual funds yourself to get to the same level of communication. And the irony, I guess, to sort of simplify it, we used to have a minimal know your client, and the advisor knew the product and enjoyed the product. In many cases, that was one of the reasons they'd gone into giving financial advice, to a much greater demand to understand the client. And with the benefit of technology and data management, we're just starting on that journey. At the same time, we're simplifying products so that it is explicable and more predictable. May not actually have as good a returns, but has more predictable outcomes. And that's where fundamental change is underway. Will be in other countries very soon too, because the regulation around the world is very, very similar.
And I think that part of the difference, as you describe it, is financial advice used to be full of stock pickers. And their ambition was, we're just going to shoot the lights out, aim for the highest return we can possibly get. When you anchor to goals, everything becomes a bit different, because, well, that maybe isn't necessarily the best choice, because it might mean I get to my goal really quickly. It might mean I never get there, and that's not a satisfactory outcome. So that's another thing that's driving that change away from the investments. And we see it all the time in the news coverage of financial services, that advisors less and less see themselves as pickers of investments, and more see themselves as the person who's going to uncover in their client what their true objectives are and uncover what their goals are. And for example, ask those questions like, do you have an aged parent that might be requiring some financial support from you in care? Do you have a child who's struggling to buy a house who you might want to support into their house? These are often questions that don't get asked, and they're not understood, and the plan doesn't accommodate for them.
Well, of course, we're now, baby boomers change everything. Amongst the other things, their parents are also living for a long time. So You can have a baby boomer responsible for the financing of not only their own generation, their own kids, their grandchildren, but their parents as well, waiting sometimes for the benefit of inheritance from their parents, and the complexity that adds to the process. So yeah, nothing now has prepared us meaningfully for the complexity of the next 20 or 30 years in financial planning. We really have hit a tipping point, and taking into account the consequences of preferences. I've got 4 grandchildren. I'm very pleased to had one get a partial scholarship to a secondary school. What a wonderful thing for a grandparent. What a great gift. Because without that, there was another several years of support. The complexity of life needs to be reflected in the financial plan.
Now, we've arrived at informed consent, which is something you raised earlier. And on its face, it means that the client understands and accepts the financial risks and agrees to take them on and participate in their plan. And this is a departure from what many people in financial services would be used to. It's very common in medicine. If you've had a surgical procedure in a hospital, you've been through an informed consent process. The doctors go to great lengths to explain to you, look, this is what your condition is. This is what my treatment options are for your condition. I'm recommending that you go with treatment B because of these reasons, 1, 2, and 3. I wouldn't go with treatment A because of these reasons. I wouldn't go with treatment C because of these reasons. But ultimately, the decision is yours. And that procedure doesn't go ahead until the person goes, okay, I've heard what you say. I understand these risks. I'm going to sign off and say that I accept them. That's not a process that we've been commonly seeing in financial advice, where often there's such a trust relationship between the client and the advisor that the client is signing on blind trust rather than understanding.
Big change, isn't it? The informed consent is, as one of my Australian colleagues put it, the legal prophylactic that protects you from unhappy clients, but that's just a preventative piece. It is at its core, you're showing your vulnerability and reflecting the client's vulnerability. It's invariably the matching of assets to the liabilities of the client, which is the goal of financial planning, is full of uncertainties and vicissitudes of both the advisor's life, the client's family, and the markets. And there should be no surprises. Disappointments, yes, but surprises, no. And we're in a world of great change, and the best way we can build relationships with clients, and I think we're all wrestling with this, the challenge of trust and confidence that comes from behaving. Trust at its basis is behaving in a trustworthy manner. To do that, you really do need to have proper disclosure and proper recognition. And suitability goes to that. It basically says, look, the markets will correct. We probably aren't going to be very good at market timing. And in fact, many advisory firms say we just don't do market timing anymore, but we understand it's too difficult to do with any level of certainty that will add value. There may be times when you're going to have to change your behavior, change your spending pattern. Let's explore both, not only just market scenarios, but behavioral scenarios to see what would happen over a period. You may not be able to spend as richly as you would prefer, or maybe you'll have to preempt the movement of a non-financial asset such as the equity in a house into a financial asset by use of either an equity release, reverse mortgage, or selling down, or doing a deal with the children to preempt that they give you some money in exchange for an agreed inheritance. That there are many ways that ongoing suitability may be matched by not just product, but behavioural change within the family and in spending.
Informed consent is its own challenge. An oncologist wrote a column for the Guardian newspaper recently where she described trying to obtain informed consent from a person with cancer for a procedure, and she could see that they weren't really taking it in. They were in a terrible life situation. Their ability to analyse what she was telling them was fairly limited. And she said, I got the signature, but I sort of knew that they hadn't really understood what I told them. And in financial advice, this is an ever-present problem, trying to get people who aren't skilled in financial matters to understand things like risk return profiles. Even a common problem that we see around the world is that people will build a house on a 1 in 100-year floodplain on the basis that they had a flood there 5 years ago. I'm going to be okay for the next 95. People don't understand risk and return. So trying to explain it is often very challenging.
And all you can do is do it. I'm often reminded that this is a journey to get, as one of my colleagues, properly informed consent. So add another term to it, is an extraordinary challenge. What we can do is just work at it. Informed consent requires that we listen to the client. We find, if you will, their preferred learning style. Some people like numbers and words and facts. Others prefer to see images and graphics, yet others prefer to read. Others will continue to say, look, you're the boss, Mr. Advisor, what would you do in my circumstance? And yet others are absolutely terrified. The challenge in here is we have to deal with people as they are, not as we would like them to be. Informed consent is a journey. It's not a place that people will get to easily, and we have to deal with people as their competencies and capacities degenerate with age. So this stuff has to be very personal and very simple. And I'm always brought back to this, to the argument that I heard very early in my career, that you need the assumptive sale, giving people two options. Sir, would you like the blue shirt or the pink and short sleeves versus long? You've got to make the decisions when you're asking for informed consent to be relatively straightforward and for people to see the outcomes. It's a real challenge.
Now, the final element of suitability is to monitor and maintain it. And as you've just been talking about, people change over time, their circumstances change over time, financial products change over time, markets change over time. And the monitoring and maintaining won't be a new concept to most financial advisors, because most people would have a review process with their clients every 12, 18, 24 months. They'll come together with their clients and have a review. And essentially what we're saying here is that at that review the suitability of that connection between the product and the client. And if there's been changes that need fixing, that's when you fix them.
Yeah, and that's the value of the relationship. That's the value of a plan. There's no particular benefit of having a plan that said we were going to get to Newcastle if along the way our car blows up and we have to stop in Birmingham, if I can borrow from our UK colleagues. So ongoing suitability is critical. It's often very lightly looked at, and because we're chasing. We see advisory firms chasing their clients, not recognizing that they have obligations to their existing clients. Once again, getting that balance right is really important. So let me remind people of the Australian Royal Commission into mis-selling of wealth products that is going through its final stages of implementation here in Australia. What we saw was a number of very substantial financial organisations that collected fees, ongoing service fees, ongoing suitability fees, if you will, from clients, but when pressed were unable to even know whether there had been ongoing suitability service provided. Now, the consequences for that for those firms was horrific. In the case of one, Australia's largest financial planning group, it had been founded in 1849, so it had gone through several metamorphoses over time. Its share price is now languishing at $2.40. Less than a year ago, it was at $5.40.
But
Four
for
directors.
People, sorry, for people outside of Australia who don't know AMP, the company that you're talking about, the Royal Commission found that it was charging ongoing fees to dead people.
So yes, the epithet grave robbers to a company almost 200 years old. The consequences, now we've all within the industry know that fees for ongoing service with very light fees has gone on for an inordinate period of time, probably the last 20 odd years since ongoing fees became an opportunity. In this case, the organisation, the advisors, their staff, their customers, there were 3,000 odd advisors, the share price dropping, class action lawsuits, the whole senior management team being replaced. Major problem. At its simplest level, all that happened was they were very good at charging the fee, but had no evidence that the service had been provided. There was no effective ongoing suitability process they could point to. So our fifth proof, doing ongoing suitability in the case of AMP, and AMP just was the worst. There were several others that along the way that had systems and processes that were neither broken but probably never existed in the first place to make sure ongoing suitability was done well.
And it's not just Australia when we talk about these. Once again, we're back at fees because they do run through all of these 5 elements. It's not just Australia where ongoing fees are in question. In Canada, we have class actions against fund managers who are charging ongoing fees. In the US, we have class actions. There's legal action being mooted in the UK. Suddenly, all around the world, people are looking around going, hey, what are you actually doing for that trail fee that you charge?
And that's where we are at the moment. And of course, what that feeds into at a highly personal level is the value of the advisory business. So in Oz, we've seen advisory businesses that were selling at 3 times revenue, now going down to 1 times revenue over the last 6 months because the certainty of an ongoing service fee has gone.
So I'm going to end us up where we started out, which is on what we call the wheel of virtue, the 5 elements. So Paul, put these 5 things together and a couple of things happen. One, we'd say that you meet the regulatory requirements of markets like the UK, of Australia, if product governance rules were to come in here, of Canada, where they're talking more and more about suitability requirements like this. The US might follow that. There's a big debate in the US even today over fiduciary versus best interest versus suitable advice. But not only does it help you meet regulatory requirements, it's actually the right thing to do.
And it's part of the maturity of the industry, our transition from product sellers to service providers, I think you described it earlier. It used to be buyer beware. It's now seller beware. It means everybody in the service chain has an obligation. It means regulation that takes into account the behavior of senior managers. The corporate veil has been broken. Senior managers in the UK and soon Australia are going to be involved in personal family liability for unsuitable advice. It's the shift from paternalism, I know what's right for you, to collaboration, where it's the client's family taking some responsibility through informed consent. And it's the drive to synthesize the data into coherent systems. So go back 5 years, in many countries, the various suppliers in the service chain ran closed architecture. You couldn't move data around. Now with open banking and open APIs, the data to pre-populate suitability is becoming increasingly used. So these are fundamental changes underway, and the wheel of suitability, the cycle of virtue, is well underway. It's got good momentum.
Okay, Paul, we're coming up to our hour, so we're going to wrap it up here. Thanks very much for your company today.
Thank you, Craig.
And folks, thank you for being with us. If you'd like to follow up on any of these aspects, the financialsuitabilityforum.com is where you go. There's more webinars there, there's podcasts, there's blogs, there's details of the regulations, and there's a chance for you to get involved in discussions around suitability, pose any questions that you have, help out people who are in similar situations to you who are trying to work their way through it, because you're not an island, everybody is confronting these same things. So thanks very much for your company. Please do check out the forum, and we'll be with you again for another webinar soon. Goodbye for now.